Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Hey, thanks for joining us on Talking Real Money. I'm Tom Cock. Don McDonald has the week off, and the show really is about you, not so much about me, because I will blather on for hours about money and finance, and finally my daughter will come in and tell me to be quiet. Well, she does that anyway. But so give me a call, because we'll take up your topics. 855-935-TALK. That's 855-935-8255. And by the way, if you won the Mega Millions, you move right to the head of the line. And you know the special number to call for that, right? Give me a ring. All kidding aside, okay, so let me make sure I got the month of July, which is closing out tomorrow, correct. Number one, apparently, depending on, which statistics or which panel you listen to, we officially moved into a recession, right? 2 quarters of negative growth. Yeah, and I know there's somebody in the back east that's going to put smoke up the chimney or something if it really is correct or not. So that's one thing, right? Okay, check the box. Number two, the Federal Reserve, again this week, raising interest rates by 0.75%. Right? Huh? Okay, check those 2 boxes. The third box is the one that's kind of a mystery. Wow. Stocks, those risky things that don't like uncertainty, that hate things like recessions and really generally don't like higher interest rates. Well, here's the box to check. Stocks had their best month since November of 2020, which by my reckoning is coming up on 2 years here pretty quick. The Standard & Poor's 500, those 500 best companies in the country, biggest and best, up 9.1%. The NASDAQ, the tech-heavy NASDAQ, up 12% in July. Smaller companies, riskier ones, they made 10.3% in July. Wait a minute. Now, wait. Interest rates went up. We slipped into a recession, and stocks went up? What's next? Well, here's the part that you need to know. No one knows what's next. In Jason Zweig's word, investors need to brace themselves for a Baloney Storm, which I haven't had since my brother likes to fry it as a sandwich about 50 years ago. Because, as he points out, Wall Street analysts, strategists, portfolio managers, and promoters declare they know what's coming next, but they don't. And by the way, the prediction is, if you want to believe the prediction about interest rates, is the Fed will keep jacking up rates this year and then slash them in the first half of 2023. Let me say that again. Rates will go up more. And then next year, some 6 months from now or so, the Federal Reserve will actually start cutting those rates. But time after time, economists and other forecasters, as Mr. Zweig, who writes regularly in the Wall Street Journal, points out, have called interest rates wrong. Let me give you a few examples. 2009, dozens of economists polled in the Wall Street Journal Economic Forecasting Survey predicted the Fed's benchmark rate would shoot up to 1.04 from 0.14 over the coming year. Instead, it barely moved, stayed at 0.17. All right, let's advance to 2014. That same panel of economists called for the Fed funds rate to hit 0.96 by the end of 2015. Instead, it came in at 0.34. 2018, forecasters expected the rate to hit 2.9% by year-end 2019. The actual number, about half of that, 1.55. A year later, the forecast year-end 2020 was for 1.48, 1.5, but instead, 0.09. Yeah, that's not my report card from my first year in college. That's actually the number of the interest rates, short-term rates were at that point. So nobody knows nothing, in the words of the late, great John Bogle, about what's coming up next. So what do? Well, your portfolio, as we have discussed several times on this program, both radio and podcast, is about you. It's built for your returns, your ability to take risk, And that's it. It doesn't matter what's coming next. You need to, number two, know your objectives and your limits, how much volatility you're willing to accept, right? Because it's going to happen again. I don't know when. It might start on Monday. And here's the other part that's really harder. Not including the show, you need to tune it out. Because we're not going to make predictions because we don't know what's next. We know what's happened. We know what history has done for a long period of time, but we do not know what is coming next. So don't worry about interest rates. Don't worry about the recession. Don't worry about all these external factors that there'll be new ones coming soon, guaranteed. We just know which ones they will be, whether they will be health-related or economics or war, famine, whatever is going to come along, and it will come along. There'll be a new headline here soon. You need to figure out how to not pay attention to all that, to instead know what you're trying to do with your money, how much risk you're willing to take, and in some cases, for those of you who are decumulating, how soon until you start needing that money. Other than that, it's, just argue about how hot it is outside in the Seattle area. We'll come back with your questions and calls. I think Steve's waiting. Your calls, 855-935-8255, as we continue talking real money.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to Talking Real Money, here to answer your questions about anything finance-related, money-related, making it, saving it, investing it. 855-935-TALK. That is 855-935-8255. First up this hour is Steve, who's patiently waited and now joins us on Talking Real Money. Hi, Steve.
Hello, can you hear me?
I hear you just fine, sir.
Okay, thank you. So just background, I'm 64 and a half and 39 years in the Washington State Fire Service. So I have a fire service pension. And I was wondering, I guess my base question is, when I talk to Social Security about these two windfall, there's a WEP and a GPO that deduct from any payment you get from Social Security. Are they accurate normally or not?
You know, from what I've seen, Steve, generally, the windfall elimination program you're discussing, yes, the estimates, you went right to Social Security for those?
No, I just I need to contact them. I guess what I'm saying is I don't want to throw anyone under the bus, but should I believe what they're saying? Because I've understood from other talk shows like Rajiv and stuff that some people don't really understand how it works. So do you folks do that?
Yeah, we definitely do that, of course, because we talk to many people who are retiring from a variety of different municipal jobs, et cetera. So, yes, that is part of the work that we do. Do I necessarily – I think what Rajiv or others may be saying is, can you necessarily trust the advice you will get if you go to Social Security? And the answer generally, by the way, I find is, most of the time, yes. There are some times when a situation is very complex when they don't understand it. Do I think going to a third party independent of Social Security and having someone else look at this, who somebody who specializes in retirement? Absolutely. I would say I wouldn't even wait. I would just say go ahead and get that opinion and make sure you're doing it right. It's very important, obviously, because that pension and how it plays into your Social Security benefit is going to be a huge part of your retirement.
All right, thank you. And one follow-up question. My spouse, who's now 60 years old, he worked for several cities and several school districts, and therefore she also has they turned it into a 401k instead of a monthly defined benefit. Would that be also, would my work impact what she gets? Do you know?
No. If she's already turned her defined benefit into a defined contribution plan, and I'd probably be a 403B rather than a 401k. It might be a 401A, but at any rate, that would not impact your pension. No, it would not.
Okay. Would mine affect the fact that I have two federal things? Okay.
No, because hers is
her.
No, it wouldn't. But again, with any of these questions, I would sit down with a trained professional, absolutely, to make sure before I pulled the trigger on anything, because these are huge steps, whether it be pension, Social Security, et cetera. Steve, thank you for your call. I think, again, I would sit down with somebody if it were my money to make sure of that. So let me give you a question we got written in here from John, who wrote us from Grand Island, Nebraska, I believe. He said, "Hi, Don and Tom. Occasionally you talk about funds that have front load fees. And I think many of you still don't even know what that means. Load is a commission. So in other words, to buy the mutual fund, you're paying someone a fee to do that, which we don't recommend. Because in today's world, if you're going to go it alone, gosh, we've given you portfolios that are pretty doggone good at our website, talkingrealmoney.com. You simply go there and click on 3 funds at I think it's 3 funds at 3 places, something like that. It says 3 on it. You click on 3, you'll find it. It's on the home page. Paul Merriman's got a series of wonderful portfolios, so we don't recommend those. He continues and says, I have a friend I helped talk out of using and I won't give fill in the blank here, if insurance company as an advisor. And again, I would not use an insurance company as a financial advisor. I know they hold themselves out as that, but that's not their area of specialty. Their area of specialty is insurance. So if you need insurance, then sure, give them a ring, but I wouldn't use them as a financial advisor. But the person, John continues, would you be able to elaborate on how you're able to tell if it's a commission or a load product? He mentions a few here that are American funds. And he says these funds all say Class A at the end. He's also seen R6 at the end of some of the fund names. Can you explain the meaning? Well, first of all, after eliminating the leaf blower, the next thing I would do as a president of the country would be eliminate all these silly the alphabet after mutual funds, because it makes it so confusing to you. A shares, B shares, C shares, R6, etc. Okay, but very simply, an A share is truly a front-end load. That means you're paying someone, could be as high as 5.75% to buy that fund. As I said, you can buy equivalent funds for nothing, especially if you're doing this on your own. We use for our clients exchange-traded funds that have no commissions on them. And by the way, the expense ratios are much lower. So the funds I mentioned here at American Funds, I think I looked up one of them, has an expense ratio of 0.63. The exchange-traded funds we use for our clients have an expense ratio of 0.14. 0.14 versus you can see right out the gate the headwinds that somebody buying that fund face. R6 funds are, and please, I'm pretty sure I have this right, these are funds only seen in retirement plans. That's why they're R, et cetera. So I don't think you're paying a commission there. And boy, I hope most retirement plans today do not include commission products. They most certainly should not. If yours does, you need to talk to somebody. I mean, I talked to a woman today in Illinois who has never saved into her retirement plan through her employer because she claims the fees are somewhere around 3%. That is outrageous. Really is in today's world that you pay anything north of 1. So great question, John. We'll be back to take yours. 855-935-8255. 855-935-8255 as we continue talking real money.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Welcome back to Talking Real Money. We get your questions all the time, 24/7. You can call right now, by the way, and talk to me live, 855-935-8255, 855-935-TALK. But other questions come in at other various times. They're recorded, and then we use them on the show like this.
Hi, Don and Tom. I have a question about special needs trusts and mainly a third-party trust. My mom's 87 years old, and she has quite a bit of money and will be leaving it to me. I'm a quadriplegic, and I've been steered towards a third-party trust, and that would allow me to leave it to my kids afterwards. And also, my other question is to Tom Cox. Did you run a station in Spokane? That's where I'm at, KSBN. And if it was you, I worked for you for a while before I got out of radio, got smart, and went back to school. So thank you for your time. Bye-bye.
Wow, that is a blast from the past. Wow, because that's going back 30-plus years to the time, yes, that I owned a couple of radio stations in beautiful Spokane, Washington, which is a time that I look very favorably on. It was not the easiest time to operate a business there, but thank you for your call, and thank you for remembering me so many years later. That's really nice. Yeah, special needs trusts, they come in. There's several, and this is not our area of expertise. Now, we do work with people that write special needs trusts, but I think there's first-party special needs trusts, third-party special needs, pooled trusts. There's all kinds of things that again will allow persons to do what more specialized ways to deal with the money. But I would go see an estate planner. They've got good ones in Spokane. If you don't know one, we can certainly send you to one as well. So it's simply a matter of going to our website, sending us a contact us form, and we'll get you one. But and thanks again for remembering my time in Spokane. 855-935-8255 is our telephone number. And when we come back, we'll talk to Gene. We've got some other topics as well to take in. I do want to mention, this is pretty special. As you know, we have been educators trying to help you get things right about money, investing, all of that for a long time. But there are sometimes those of you in the audience who are women whose situations are a little different than being married or being single man, et cetera. And so we put together 4 different classes: understanding personal finance, thriving after divorce, life as a widow, happiness is an inside job. These are specifically taught by women in our organization for women. The first one is coming up a week from today at 3 o'clock Pacific time, and it's called Understanding Personal Finance. Learn just the basics, because you got to have a starting point, right? And if you want to attend, these are online webinars, really taught by some outstanding folks that are associated with our company. You simply go to Apella Capital, that's APELL Capital, CAPITAL.com, ApellaCapital.com. Click on events. You'll see these classes. There's 4 different classes, and I think it looks like one a month. Again, they're taught by some truly outstanding folks that are part of our organization, and they're taught with you in mind. You know, when I do a class, I've got another one coming up on September 17th. It's very general because we can't specialize. This is specialized because there are things in your life that are going to be different than they will be in my life as a married man. And so, and again, and this is, by the way, something I've told my wife. And she was really got upset when I told her about this last week because somebody else that we knew just passed away. But I said, you've got to know this. Right now, you rely on me for it, and you shouldn't, because I might not always be there, which after considering what had happened recently, made her upset. But the point of the matter is all of us are responsible for ourselves, our own lives, especially our finances. So here's a place to start. If you're a woman and said, I don't know anything about this is not saying anything bad about you or your gender, but specific to you. Again, AppellaCapital.com. Click on events and join them next week for the first class. Coming up, we'll talk with Gene and others here on Talking Real Money.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Reality radio for a really great future. We're talking real money.
Welcome back to Talking Real Money, where we take your questions and calls about your finances, your money, your investing, any of that, 24/7, by the way. Love to have you call us here in the last half hour of the show because we've got some lines open at 855-935-TALK. That's 855-935-8255. So join us. If it doesn't work right now, you can call any other time. We take your questions and calls, and we'll try to get to them as fast as we can, either on the program or the podcast. So, yeah, Talking Real Money is a very popular podcast, which we hope you will listen to. Let's go back to the phones, and Gene joins us here on Talking Real Money. Hi, Gene. Did you win the Mega Millions?
I heard you had to buy a ticket in order to win.
Yes, that is a critical part of all of this. So sadly,
Yeah,
you and I are in the same place.
yeah.
We're not. You got to be a player to make the money, and I'm not a player. So good for you. How can we
There you
help?
go. Well, my dad died last year, and I now have power of attorney to take care of financial stuff for my mom. And so Dad, several years ago, bought a fund. It's through an organization called Thrivent, THR.
Yes, I know Thrivent, of course. Mm-hmm. Yep.
And so this is a bond fund.
What's the ticker?
It's LBLAX. So this is supposed to be a short-term bond fund. Okay, so just a little context. Okay, my dad was a school bus driver and a janitor.
Mm-hmm.
My mom was a cook. Anyway, so there's a significant portion of the money that Mom has is in this bond fund. It's
What percentage, roughly? Well, that's okay. I mean, what's your question around this fund? Because I can tell you right now, having just looked at it, I don't like it. I'll tell you why in a couple of minutes.
Well, it just didn't. The idea of a short-term bond fund. My mom's 92. It doesn't seem right to me, and I'm trying to figure out what the right kind of move would be.
Yeah. So is this in a retirement account, or is this in just a regular taxable brokerage account?
Brokerage account.
Okay. So, just to go to the fund itself, you're right. This is a limited maturity bond, but this is a loaded commission product. In other words, you're paying a commission of some kind, could be up to 5.75% for that. But here's the more important part. A short-term bond fund where the expense ratio is 56 basis points. The yield is around 1.2%. So half of the yield is going to pay the people running it. So whether or not it makes sense in your mom's portfolio is another question. Does she have other assets? I mean, this would not be something, this particular fund for short-term money I would never use because, as I said, it has commission and it's very expensive operation. But to your other question about whether or not your mom should have short-term bonds, is this money she's going to need in her remaining years?
She's 92. Things happen fast in the 90s. I don't know. I'm presuming this is money I might need to tap in. At a moment's notice.
Yeah. So here's what I would do, because you can get this now. I mean, there's probably not much gain in this fund. You could probably sell it, not have any capital gain, et cetera, et cetera. I doubt there's been much gain at all in the last few years if she's been in it for a period of time. I would simply go, for example, to a short-term high yield savings account, which you go on online, bingo, bango, set up, and they're already paying up to close to 2% a year. Or Vanguard's got some very fine short-term bond funds as well. So if it was a matter of still having money in a short sort of duration fund, they're out there. Thrivent is not a place to go buy this. Thrivent is sold. It used to be called the Lutheran Brotherhood, so it's kind of an affinity sale. Obviously, with a group of Lutherans. Nothing against Lutherans, because my brother's a Lutheran. I think they're fine people too. But this is not how you should have your money managed. Nothing against Thrivent, but this is not a very good mutual fund, because for a short-term bond fund to be paying 56 basis, 0.56 for that is outrageous. Part two, to be paying a load for a short-term bond fund doesn't make sense either. So I hope that helps. Again, you'd want to first sit down, though, and make some determination about how much money should be kept sort of in a cash-like portfolio for her use, as she is 92, and that could, as you say, come quickly. We'll be back with more 855-935-8255 as we continue talking real money.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to Talking Real Money. Here to take your questions and calls. Anything money related, 855-935-TALK. That's 855-935-8255. Hi, I'm Tom Cock, handling the program by myself. Today, Don McDonald, sadly, on his way to his brother's memorial service in New York. He will be back next week. Thank you for all the good wishes, calls, emails, etc. It's really nice, all the people that have reached out to him. This has been a very difficult time, obviously, for Don and his family. So thank you for that. Let's go back to the telephones. Hannah now joins us here on Talking Real Money. Hannah, we got one question for you. Did you win the Mega Millions lottery?
No, thank you.
Oh, well, I guess our relationship is going to be rather short-lived then, but go ahead.
Okay, thank you so much for taking the call. Mike, I have two questions. First question is about this bond fund. I'm invested in the Fidelity. So I wanted to know what your opinion about the short-term or intermediate term bond in current situation. Should I invest on the short term or actually using the medium term? I think Fidelity has general fund is intermediate, but they have also short term.
Of course. And how long until you're going to need or use any of this money?
I think it was in about I'm 60 years old, so then I think it will be in the 5 or 7 years. I will consider about retire. But I don't really necessarily need to really touch this. This is my personal investment, not my 401k. So I
okay. Well, so what's the purpose? Then what's the purpose of the money that you're looking for to put in a either short or intermediate term bond fund? What is
for the retirement? Yeah, it is part of my portfolio. This is a bond portfolio. I have also the equity. So
all right. So this will be money that you draw on at some time for retirement.
7 to 10 years. Yeah.
Okay.
Yeah.
So I mean, in a general sense, bonds, as you know, the longer maturity, the riskier the bond. Correct? I mean, you've seen that this year, because if you own a bond fund, or pardon me, if you own a bond that has a 30-year maturity and it was only paying 2%, and new bonds are being issued today at 3% or more for long-term maturity, the bond that you hold is going to go down in value because people would rather buy the new one at the higher rate. That's why owning a bond fund makes sense, but only you mentioned short and intermediate term. I don't recommend any bonds over about a 10-year maturity because they take on additional risk, as I just mentioned, of fluctuation in interest rates. Then to your specific question about short or intermediate term, for our clients and for people that look at our website, we give you bond funds that have both short and intermediate term. Remember, a short-term bond fund today is paying, 1.5%, something in that area. An intermediate term, which could go anywhere from, 4 years to 8 years or 9 years in maturity, in that range, is probably still only paying, 2.5%, maybe a little bit more. And again, to buy a bond fund for yield, in other words, to kind of buy riskier bonds doesn't make sense to me. The academics are going to tell you that you're likely to end up losing money because those are riskier, either governments or corporations that are paying a higher interest rate for a reason, right? I mean, they were selling Ukrainian war bonds 6 months ago for, 28% because maybe you get your money back, maybe you don't. So back to your question, Hannah, I would own a mix because what you get then is a variety of interest rates. You could have some in short term, some in intermediate. You could probably, in my mind, have 2/3 of the money in an intermediate term bond fund, 1/3 of the money in a short term. In other words, the intermediate's going to give you some return. The short, not really very much. And in fact, in a period of time when inflation, as you know, is running at 9% or whatever it is today, you really want to have something in there that gives you some protection against inflation. And by the way, you could consider, if this is in a retirement account, owning Treasury inflation-protected securities. TIPS, Fidelity has a very fine TIPS fund. Maybe you own all three of them because that gives you some protection against unexpected inflation, which we've definitely had this year, and we may in the years ahead. We don't know what's coming next. So I would probably own some of both of those rather than trying to pick one or another. Does that make sense?
Yes. Is there any one fund in Fidelity has this kind of a mixed portfolio, or I have to buy two different funds? One is for intermediate, one is for short term.
Yeah, no, I mean, you could go in Fidelity, I'm sure, has an aggregate bond fund of some kind, total bond, Fidelity total bond.
Oh,
you're going to get
okay.
Yeah, you're going to get a little bit of longer term, not much, mostly intermediate term and some short term. But that's a great question. Got to run, Hannah, to another caller. See if we can squeeze call in before the top of the hour. We go to Gates, who joins us here on Talking Real Money. Hi, Gates.
Hi, Tom. Appreciate you taking my call. Calling from Auburn, Alabama. I've got a question about donor advised funds. I have brokerage accounts. My wife and I have brokerage accounts at Vanguard and Fidelity and a third company that's not very user-friendly. Can Appreciate Assets mutual funds from the third company be moved tax-free into a donor advised fund at either Vanguard or Fidelity and then distributed from that donor advised fund?
Sure. Yeah, there's no tax ramification to moving that to a donor advised fund. Absolutely.
So they wouldn't have to be sold. They could just be moved,
right,
and then the
moved
donor
in
advised
kind.
fund could distribute them.
Yeah, correct.
No,
I think donor advised funds are a
simple.
great way to give away money. I think it's a fantastic way. You manage it and you hand it out as you wish to the charities or organizations you think are worthy.
Well, I really appreciate that. That's been very helpful.
Well, we appreciate you listening. How is it down in Auburn, Alabama today? We're uncomfortable here in Seattle, but I imagine Alabama's a little more uncomfortable this time of year, no?
Actually, we hadn't hit 90 yet today, but it'll be there tomorrow. So it's Alabama, and it's the end of July, early August, the hottest time of the year. You gotta take what you're dealt.
Indeed. Yeah. Well, I'm loath to complain here because we had a horrible spring where the sun basically never came out. And so now everybody's, it's so hot. I'm like, well, yeah, but I'm not going to go back to when it was, raining and 50 every day too. So hang in there, Gates. Thanks for your call and your question. I do want to mention there's a couple other ways to ask us questions if you're shy about being on the show. Oh, it looks like we can try to see if we can squeeze Eric in real quick. You can go to talkingrealmoney.com to ask questions. Eric, go ahead. We've got just about a minute left here. Go.
Okay. I got an IRA, and I'm 72 years old, and I have about 240 in the stock market in different stuff. But in my IRA, I had CDs, and then they cleared up about a year and a half ago, and I was scared of the market, and I wasn't getting no interest, so I just let it sit there. So I got about 400,000 still just sitting there. And now with interest rates going back up, this is kind of my 401 protection money to where
Eric, we're going to have to take this up at another time. Thanks for joining us here on Talking Real Money.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hey, join me for an upcoming class both in person in Bellevue and online called Retiring in a Recession. How to take care of your money, how to draw Social Security and get the most from that. Really how to get all these things right around retirement. It's easy to register. You can go to talkingrealmoney.com, click on classes there. Same thing at Vestory.com. It'll be Saturday the 17th, in person in Bellevue, live online. Join me. You'll learn something, I guarantee, at Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.